So the tactical pieces are like how we put these things together, but the transformational part of this is the outcome that we're really searching for. And so the framework is what's called truly passive income. And we believe that truly passive income is to your freedom and impact as compounding interest is to your money. And once that sinks in, right, everything changes. And then it's just a laser to like, how quickly can I get rid of this apartment complex? How quickly could I sell this massive primary home that's on the beach that's increased in value by from 2 million to 15 million, right? Or this business or this Bitcoin, whatever it is that you're exiting. And that's the encouragement for everyone today. Is it's like really clarify what you want most right now and then make the moves to accomplish that.
Hello, everyone, and welcome to another episode of the Adventures of a Real Estate Broker with Daniel Berger. Thanks for being on with us today. I'm excited to have all the way from Florida, Brett Swarts, who basically is going to help us try to prevent. There's two things right in life that you can't prevent: death and taxes. And he's not a doctor, so it's not going to be about preventing death. It's only about how to minimize tax burdens. And there's some cool strategies, and I follow some of the things that Brett's been doing, and I'm intrigued, if not for everyone on the podcast, at least for myself. So I think with that, I want to thank Brett for coming on.
Daniel, grateful to be here. Thank you so much for having me.
So what's interesting is doing some research on you. I love you're the best-selling author of Building a Capital Gains Tax Exit Plan. You also have a podcast. You're the founder of Capital Gains Tax Solutions. All things that if your plan is to build wealth, if you're building wealth and then you're paying it all in taxes, it seems like that's not the greatest plan. And it's also starting, your plan should know what the end's going to look like, as opposed to just starting to do stuff and then not, because you might not have structured stuff in the way. So how do you go about bringing in people into the market, or how do you sell your program?
Yeah, great question. In the beginning, the way I would sell the program was really the tactical, right? You're in New York. I'm originally from California and then New Jersey. These are some of the highest tax states. And it was very numbers of 20, 30, 40, 50% deferral and eliminating the need for the 1031 exchange and those kind of things. The more I've been in the business, the more I think people are looking for, I think more than that, they're looking for those they can trust to help them steward their wealth for their family, with their family for generations to come. This 124 trillion transfer in the next 5 to 15 years is the largest in the history of the planet. And that starts really with understanding and helping to be a guide through what's called family mission, vision, values as it pertains to their wealth, as it pertains to their real estate, as it pertains to cash flow and asset protection and diversification. And so it's bringing, especially in the real estate world, Daniel, bringing what a lot was in the financial or the estate planning world and combining the two with the tax strategy. But really the overall umbrella is, what is the family mission, vision, values, and what are your perfect life metric numbers at the end of your life for passing this wealth to your family? And the reality is, if you do not plan and be intentional, the government will make a lot of these decisions for you. And unfortunately, that's the part where we want to make sure that the people we serve have the freedom and flexibility to do what they want, when they want, how they want, is within the tax law.
So I know that your program is based off of having a strategy, creating a structure, executing that plan, and then obviously optimizing the wealth at some point, which is obviously, what do they say? That failing to plan is planning to fail, and especially in this world. So one thing about the taxes is, as we know, politicians come and go, although actually it would be better if they sometimes went, right? Sometimes they stay around a little bit too long and that's apolitical, right? That's on both sides. People stay along forever. But so tax codes do change. So I guess that's the other thing, is you need to have a plan that can be flexible based off of as things change down the road, that you're able to adapt what you have. Is most of what the people that you work with, is it mostly in the real estate world, or would it also be other types of assets as well?
Yeah, good question. About 50% of all the sales we have is real estate, 30% is business sales, and 20% is other like stock or Bitcoin, cryptocurrency. So that's the rationale. And so I like to start with a story when it comes to these things, right? Warren and Catherine, they own this multifamily property in California. They did 1031 exchange. They had about 2.5 million of wealth inside of this property, and their cash flow was about $120,000 per year. But the biggest thing they were struggling with is the ability to spend time and energy with their family. In fact, Warren was traveling back and forth to this property, and his wife, Catherine, said, I really would like you to be home more and us to travel more with the kids. They had kids a little bit later in life. And that's really the key here. It's like clarifying what matters the most to you and your family for your wealth. For a long time, a lot of my clients, they were in the accumulation phase, right? And then they were in trying to be passive cash flow, right? To replace their active income. But that passive really wasn't that passive because you still have to manage the manager and deal with the toilets, the trash, the termites, the rent control, all of the things that make owning properties a real challenge, or owning a business. And so the point is, what matters the most, a lot of people want what's called truly passive income. They want the ability to say, all right, I don't actually have to trade even my time for the dollars. I can really be diversified. I can be out of debt. I can be tax deferred until I take payments, in our scenario, from a trust slowly over time. And that's really the key here. Like, as soon as you identify what matters the most to you at this point in your life, then the rest of it becomes really clear. So for Warren and Catherine, they identified that their time and their energy with their two twin daughters was the most important thing. And what was the obstacle in the way was the property. So we sold the property, deferred all the tax. We increased their NOI from 120 to 190. But most of all, we got all of their time back and none of the stress that's dealt with owning real estate. And you go, that's what's transformational, right? And so the tactical pieces are like how we put these things together. But the transformational part of this is the outcome that we're really searching for. And so the framework is what's called truly passive income. And we believe that truly passive income is to your freedom and impact as compounding interest is to your money. And once that sinks in, right, everything changes. And then it's just a laser to like, how quickly can I get rid of this apartment complex? How quickly could I sell this massive primary home it's on the beach that's increased in value by from 2 million to 15 million, right? Or this business or this Bitcoin, whatever it is that you're exiting. And that's the encouragement for everyone today. Is it's like really clarify what you want most right now, and then make the moves to accomplish that.
I think that's also, I think it's important. I think a lot of people don't really have plans, right? They go about doing stuff. I've seen people that are getting into, they become investors, but yet they don't set up LLCs. They're like, they buy it, but then they're not really doing it in the way that you really should potentially do it. I guess the biggest thing is you have to have things that work for you. And it does seem, can you explain a little bit the difference between a 1031 exchange and the Deferred Sales Trust, the DST?
Yeah.
Because it seems as though 1031's exchanges, while they are ways to delay taxes, they're very onerous, right? Because like when you sell a property, what do you have, 45 days to pick what property you're going to buy? Then you have to buy an X period of time. It is if you fit into the box, it's fine. But certainly there are boxes they're probably better boxes to be in. So can you explain a little bit more for everyone what 1031 exchanges are, the limitations of the 1031, and why you feel that a deferred sales trust is probably a better tool for people?
Yes, the biggest challenge with the 1031 exchange that I have found is that it really doesn't solve what someone truly wants, typically, which is truly passive income. The reason it doesn't solve for that is because it typically involves you having to purchase something within a short period of time, and honestly keeping you within that world of what's called investment real estate management, investment real estate purchasing with banks that are more and more challenging to purchase deals with. And so, number one, you have to buy when you don't want to buy within a 45-day window, basically to 180 days. Number two, you cannot diversify, meaning you have to put it all into investment real estate from investment real estate. Number three, you have to replace equal or greater debt. And this is where people are getting in trouble. Their mindset is off. They're thinking just cash flow. But cash flow is just one piece of the proper mindset for a wealthy, smart investor. The second piece is what's called tax flow, right? And the third piece is called debt flow. And you've got to really look at all three of these and and it's like seeing in 3D or seeing in color versus not seeing in color when you're just focused just only on cash flow. So what that means is on a 1031 exchange, I have to do equal or greater value and equal or greater debt. What happens when interest rates go from 3.5 to 6.5 to 7 to 8%? If I'm trading, I'm having to buy or go into more riskier debt. And if values haven't shifted to offset that, which they really haven't, then I'm stuck. I'm stuck with more risk, less cash flow, and probably in a position that really doesn't solve what I want, which is typically truly passive income. And so with our strategy, with building an installment sale with the trust, we're able to not only defer your tax, but eliminate the need for the 1031 exchange, help you to get out of debt completely, and give you timing to invest into strategies and investments that make sense for you when they make sense for you. So those are some of the main differences. And I'd also add on our strategy, it works for any asset of any kind. So businesses, Bitcoin, stock, real estate, primary homes, investment real estate. Whereas a 1031 exchange only works for investment real estate. Doesn't work for Bitcoin, doesn't work for stock, doesn't work for primary homes. Ours does, right? And so those are some of the key differences.
So I think it is true. Like me being a real estate person and also a broker and still having some years left to work, I don't know if passive income is technically what I need, but it certainly would be for most people, right? Because most people if you're a teacher or a business person, right, you want to divest from the stock market, or you get an inheritance or something, and you're trying to diversify your portfolio by getting into other things. You don't want to be the person that has to worry about leasing and fixing the toilets and tenants and right and contracts and all that. So I do think it is a little different. It depends on where you are, but certainly it seems like that the DST is something that's a little bit more flexible. So basically so it's a trust that you basically are. So if I sold a house and I had gains, I can set up this sales trust with the gains, and then how do I do that, and what would be the restrictions?
Yeah, we'll do an actual deal. It brings it to life. It was about an $8 million sale next to Stanford University in Palo Alto. And this particular owner he actually had 6 kids. He was a single dad at this point, and all of his kids were out of the house. And the majority of his wealth was in this house. He had the value had really increased, right? So he had a big old massive tax bill when he would have sold. And he doesn't want to do a 1031 exchange. He wants to retire. He wants to move to a different state. He wants to establish residency there, and he wants to basically retire. Actually, funny enough, he was a real estate broker himself. He would sell about $100 million of real estate every year in Palo Alto. And he was one of the top in the world of what he did. And he set the structure up. What we did is we basically did and this one, it was like a two-party sale because it was in his primary name. So it was like a 2-party transfer where he's selling it to the trust and the trust is selling it to the ultimate buyer. And then he's getting a promissory note. So the property is gone. All the money comes into the trust, but the trust buys and sells for the same price, Daniel. So the trust has no gain. So therefore it has no tax. And then at his level, he's only paying taxes. He receives payments back slowly over time. And that's the whole piece of this. If you sell on and report it on an installment sale method, to the extent you don't receive any payments at closing, you're in a tax deferral state. And you only pay taxes you receive payments. It's known as IRC 453 installment sale reporting. Tax code goes back over 100 years. Collectively with the tax attorneys, we've done over 1,000 transactions and about 30 audits, no change, no findings. And our role as a trustee, I happen to be a real estate broker myself, started at Marcus and Millichap, doing 1031s. This is how I learned about all these kind of things after the '08 crash. And so once you understand these pieces of escrow, buyer-seller trust, and basically assignment and or selling for a 2-party transaction, and in this scenario, it's really a 3-party transaction because you also have the trust, that it simplifies. You used to do one step at a time, but the end result, smoke clears, buyer has the property, they get it free and clear, and then the seller has a promissory note, and the trust is the one that's right in between them.
Obviously, it's always good to defer taxes, right? Deferred taxes to when your income is less. That's the way that we can't not have the taxes, but obviously you rather have it when the burden to pay higher amounts or will be less because you're not making as much. What do you say when people are like, "Oh, the DST, it sounds complicated. I don't have enough." What do you feel would be like a minimum for where the DST would make sense over some other, either just paying the tax, doing a 1031, or nothing, right?
Yeah, great question. So I'll start with non-primary homes, okay? Just because the primary home has what's called the 121 exclusion. So when does the deferred sales trust make sense? Number one, you have $1 million net proceeds, $1 million gain, at least on the sale of any asset of any kind. And you don't necessarily need or want to spend all the money on your personal consumption. In other words, you're happy to have the trust invest, and diversify, and then to pay you slowly over time to pay tax. Now, if you're in a primary home, I'd like to add another million to that. So $2 million net proceeds, $2 million gain, because if you're married, you have what's called the 121 exclusion, which is $500,000 tax, basically tax free on the gain if you're married, or $250 if you're single. So that's for the primary home. As far as the complications are concerned, it's no more complicated than a 1031 exchange, or if you ever have an IRA or a 401k. The difference is, Daniel, you just hear about those all the time, right? You hear about 401ks and IRAs and 1031 exchanges. IRC 453, you don't necessarily hear about, and you don't hear about it, how it combines with the trust. And that's really the secret here, or the stuff that's really helps you to make it simple, that it's just an installment sale with a trust and a third-party trustee. And the reality is most people aren't doing 5, 10, $100 million exits every year, every month. So they don't really know. And so they're trusting their brokers like yourself, Daniel. But what happens is, if Daniel has never done it before or is not sure about it, then they're going to lean on that piece of it. And so this is part of where we come in at Capital Gains Tax Solutions as real estate brokers, a broker ourselves, and being trained by some of the best in the world at Marcus and Millichap. We bring in that higher level of expertise to train and coach real estate agents and brokers on how to do this. We teach and train CPAs. The cool part of our strategies, you're not just relying on that, you're relying on a tax attorney and a CPA who has done this for nearly 30 years, has been through all of the audits. So it is definitely a team effort, but I would also say that it's not for everybody, right? There are some complexities. You have to give up some controls to the trustee. That's our role. You have to step into something that's new, and you have to ask yourself, what is your pain tolerance as it pertains to tax versus complexity? And if someone wants to pay 20, 30, 40, 50% of their proceeds to the United States government, hey, we need some good Americans to pay down that 37 trillion, Daniel. And I don't want it to be any of the people that I work with or know, but
Well,
yeah.
that's why it's interesting what you said about how much the people that are about to retire and their taxes. You said it's the most amount of trillions, right? The most amount of money
124
that's
trillion.
going. So I guess if those people don't really have tax avoidance plans or generational wealth savers, then I guess the coffers will get lined again, and then the government will be able to decide how to waste that money.
You nailed it. And that's the sad part. We call it the reverse Tea Party that's happening right now. 250 years ago, we fought for basically the rights and freedoms with equitable taxation. And on this other side, we've built up more wealth in the history of the planet. And in the next 5 to 15 years, it'll transfer. 50% of all the wealth in America is tied to high-end primary homes, commercial real estate, and private equity, which is businesses. These three asset classes are all illiquid and are massively appreciated. And if not properly structured and transferred, are going to be crushed with the tax man, which no matter what side you vote for, they're going to probably not spend it very wisely. They might even waste it. It might be the word you'd say, right? Or squander it. So we want to be in the business of keeping it in the hands of the people, hands of the entrepreneurs, hands of those who are going to build housing, hands of those who are going to make an impact and be good stewards with the wealth. And it's all within the U.S. tax code. And that's the key part of this.
So if someone's going to someone's going to sell something or push it into a DST, how is that passive income? So explain that. Explain
Yeah.
that to me.
Yeah, so it depends on how and where we invest the funds. It's just a real simple one. You could put it in the S&P 500, and it's just the biggest companies in America at Charles Schwab, and it just produces its returns, right? Maybe 8 to 10 on average per 10-year period of time per year. And then you just live off of those 5% and let the other amount just accumulate. And let's say it was a $10 million exit in New York, and you would have paid 40% in tax. So you would have 6 versus 10. Instead, we put all 10 in there, and let's make the interest rate 9% on this note. So it's a $900,000 note. Say we earn about 10, 11% on average per year over 10 years, and you just live off of 5 or 6 or 7% and let the other amount accumulate. And that's the beauty. It's on the full 10 million that's producing 900,000 a year, and then you're living off 700,000 a year. And that's a beautiful thing. You only pay tax on that 700. Now, with what's going on recently in New York with the new mayor, you might move to Florida. You might move to Texas or Tennessee or a little more tax advantaged state. And if you establish a residency in that state and then you start receiving payments, guess what? Your income tax drops because that state may not have income tax, or it's probably gonna be lower than New York, New Jersey, right? California. So that's the other strategy of this, is looking for when you reside in certain places. Now, the nexus, meaning the capital, the principal, if you ever dip into that, will be paid in the state of New York, right? So they will have that. But most people don't dip into the principal, Daniel. They just live off the interest. And by the way, that's okay too, because the government's winning as well. The government's getting ordinary income tax off of that. It's a 1099. So they're getting taxed, they're getting paid, right? So it's not like they're not getting paid. And also the funds are invested into something that's growing the economy, hopefully, right? Now, that's if you want to do that. Now, other clients, they don't really like the stock market so much. We have private equity and private debt groups that have proven track records where we can diversify the wealth into double-digit return investments, loans mostly right now is what we're seeing. And so a lot of our clients are very real estate heavy and they're not necessarily stock market comfortable as much. So we'll go more into real estate investments. It really just depends on what they want and their risk tolerance and their appetite for different investments. And a lot of times it's 50-50 or 80-20 or somewhere in between, right? It's a mix. But we want to keep diversification. We want to keep some liquidity. We want a good cash flow. And ideally, we keep the full principal just earning and paying for the fees, paying for the cash flow to pay you back. And you look up in 10 years like, man, I put 10 million in. I lived off 700,000 a year for the last 10 years. It paid for the fees for the trustee. And man, there's still 10 million in there. Let's do this thing again. And every 10 years, you can renew for 10 years. Then your kids can step into your shoes and continue to make it go, right? Which is nice. And that's basically the premise of this all, that most people are not going to dip into principal, just live off the cash flow because that's really what they want. Most of them just want truly passive income. Some third party over there is sending me a check in the mail. That's as simple as it gets.
So basically you still have to go do the things that you were going to do to build your wealth, right? And so this is really more, okay, as we're ready to move away from whatever that investment was, these are the strategies to defer tax payments down the road. So it's more somebody that needs to sell something that's going to come to you as opposed to, right? As opposed to, oh, what's the plan I'm going to have going forward? And I guess
Well,
that the
let
question
me
is,
clarify that real fast. So that is one avatar that we serve, if you will. One of our clients is more like the baby boomer who has conquered their kingdom, has built up, was the warrior, is the king, and now is working into the sage. And they're fully wanting to be retired and out of the day to day. Then there's the other one who's still in the warrior king phase. They're still building the empire. They're a purpose-driven entrepreneur. They're ready for their next deal. They just want that edge to invest when it makes sense for them, right? They want to be able to sell, a business or real estate, and they want to invest into some Bitcoin or some stocks or some, and their own deals. So you can do both. You can do both. In fact, Warren and Catherine, their kids are 10 years old. They're like in their mid 50s. Their kids are going to be 18. Warren and Catherine are going to want to do their own deals again. Once their kids are 18, they might even want to partner with their kids. Guess what the trust can do? It can joint venture partner with you as an entrepreneur to go build a project, to go invest into your own deal, and you're running that deal again. So this is not putting you in a box like the Delaware Statutory Trust, by the way, which is another DST, where basically you're giving up all control, all liquidity, all diversification, and you're just giving it to this third-party group. Our strategy allows you to be an entrepreneur or to be passive, right?
so if you've sold something and put the money into a DST and then you find it your next project, you can actually use that DST to fund it as like from like
100%.
a
Let me give you
loan.
an actual story, okay? So we had a client sell a $3 million business in Alabama. He wanted to build 20 plus units in Tennessee, a complex of townhomes. So he did what's called a joint venture partnership. So the trust put up the capital. He was the managing member, majority owner of that LLC, all tax deferred, and he helped him to build that project, all tax deferred. No timing restrictions, no like-kind replacement requirement, right? Didn't have to put 100% of the proceeds all into one deal all at once. That's the problem with the 1031. You sell something for 10 million, you need to buy something for 10 million or more, right? What if you find a perfect deal for 2 million and the other 8, you'd rather just sit on the sidelines? Of course, this is what our strategy allows you to do, right? You can do a partial 1031 exchange and a partial deferred sales trust. In fact, a lot of the times that we're doing our planning, Daniel, we're doing both. We're sitting down with the investment real estate person and saying, hey, let's do a partial 1031, or at least go shopping. If you find your deal, great. If it doesn't work out, we're that backup plan. Or sometimes we had one other client out of Texas. He sold a $6 million asset. He found a perfect exchange for 2 million of it. And then another decent exchange for another million. And the rest of it went into the trust. So that's a great example. It's a great complement or rescue to your plan.
So I have a client, I've done like 10 million in sales just in Greenwich, Connecticut this year with one client. We just sold something that we're now looking for the next investment for the 1031. So even though he sold something like 2 weeks ago, there's still time for him to set up a DST where he can fund the money and not have to put it into a 1031 exchange.
It all depends, but generally, yes. So the first question I ask you is number one, where are the funds now? Are they with a qualified intermediary or are they still at the escrow company?
Now they're probably, I'm assuming they're with the qualified intermediary
Okay.
because he sold it and I'm thinking that they're holding on to it.
Okay. Yeah. Depending on who that 1031 accommodator is, we may be able to what's called amend the exchange agreement to give him this option as long as it's before the 45th day. So if they're amenable to amend and add some language for this option, the answer is yes. Now, let me get the other side of that. Guess who doesn't want you to know about this? 1031 companies. Some of them, okay? Because guess
But
what?
you're right, but your tax attorney should, right? So,
Yeah.
which is also interesting because so my wife and I, we use a top tier accounting firm
Mm-hmm.
because my wife's an attorney and uses K1, so
Mm-hmm.
it's just very complicated. And when I had a conversation with them last year, they're very good at me giving them my numbers and then them telling me how much I owe. And last year we had a little bit of a conversation about like, why aren't you more proactive? Telling me like instead of me just paying the tax, what are things? Look, you see my numbers. What are the things that I should be doing? All of these things. So my wife and I actually, the client that I was talking about, I was looking for other investments for him, and this year we just found in like a sleepy town an hour north of us called Beacon, there was a firehouse for sale by the town. The municipality sold the firehouse and they weren't using it anymore. And so we actually just bought this. And so I said to him, I was like, I was working as a sales agent and I said, do you ever take partners and would you want to take a partner for this? And so we had to think about it. And he has taken partners. He generally doesn't. He's usually the managing person that does everything. But we opened it up where and my wife and I are now 25% owners of this LLC that is so the only sad thing about so far with the firehouse is it didn't come with a fire pole. And you would think that you're buying a firehouse and there should be the fire pole, but it doesn't have that. But we did already we before we even bought it, we leased out the space that we found a tenant that wants the first floor and then we're going to build 4 apartments on the second and third floor. And what's interesting, you'll like this from a tax deferred situation is that amortized depreciation and all those things that you need to do. I don't think you're not allowed to accelerate depreciate it until it's a working asset. Lucky for us, there happens to be a cell tower on the top of the building that has a lease for $25,000 a year. So technically, the building is already operational as an income producer. Little old me, without the help of my accountant, somehow working with my clients, was able to. And then I bring that to our top tier accounting firm, and they're like, "You can do that." Like, I think it's important to see what's out there, and the DST is my new thing that I have to do some research on.
I appreciate it, Daniel, and I think it's a good point. Just don't just settle for the CPAs that are just doing reporting. Make sure they're going to be proactive, or at least look at these things with you. Bring them to the call with us. Sit down. We love to talk with CPAs. We love to get them on with us to walk them through step by step so they feel comfortable. You want them in your corner to look at these things. So yeah, that's why we work on a conditional basis. So the tax attorney, myself, all of us will get on and we'll talk and walk you through all of these things. If you don't want to use it, no problem. If you do, great. We're happy to help you out.
I think the point of it is that you want to get a team of experts together, right? Whether it's attorneys, CPAs, tax attorneys, because ultimately what you're just trying to do is you're trying to do financial planning for families and everyone's on the same team, right? The team is how do you put together a plan that leverages the actual tax codes and the
Right.
right? That's the whole, but is that whether
Exactly
they're
right, Daniel. Exactly right.
whether the loopholes or not, they're what's allowed in our tax
You
code.
got
And
it.
so not everybody uses them, but they're there for the using. And so you have to make sure that you're legally leveraging what's available to protect your assets
Hold on.
as much as you can. So I think that's great. Do you see anything changing in the next 6 months, a year or so between from tax codes or how this whole process with the DST might work?
No, the foundation of the installment sale method goes back to over 100 years, right? So it's not even on the radar that we know of any legislative change or any law change or tax code change. And it's way more attractive than the 1031 from the government's perspective, because it's truly an exit plan, and it just spurs economic growth because it allows sellers to become the bank, which is it's pretty foundational, because you don't want governments to be taking over all the banking or relying just on private banks. So this allows us as U.S. citizens, or anyone who owns an asset in the U.S., to be able to be a bank to get funds moving and deals moving. No challenges there. And we just, again, it's over 28 years, close to 30 years, thousands of transactions, over 30 no change audits, no change, no findings, batting 1,000, never been on a watch list, never been on a dirty dozen, never been on no trigger audits. So it's batting 1,000 so far. And I'm always interested to see how long it'll take for the entire real estate or business world to just rubber stamp it like a 1031 exchange. I don't know. There's 5,000 QI companies out
That's
there.
my
Yeah.
question. Why does the 1031 exchange lobby have such a better marketing
There's
plan than
5,000 QI companies across the country just banging the 1031 drum. And so again, I'm a part of that industry, and I grew up in real estate and in brokerage, and that's what we talked about every single day. And so that's where most people's attention goes, right? And it's
right?
not until they're opened up to this new one. And I think that's where most people have done the transactions. So they're comfortable with stuff they've done. But once you see, we did a $13 million deal in San Diego. We just did a $37 million deal in Arizona. We did an $8 million deal in Massachusetts. So we've done Connecticut with the veterinarian. We've done New York. We've done Florida, Colorado, of course, Oregon, $16 million exit. We have all the case studies and the deal stories, but people don't know it until they talk to us or go to our website, go to our YouTube channel, hear our client testimonials, jump on a call with us. That's all I can encourage you to do. Keep an open mind, jump on a call, talk to really smart, sophisticated people who have closed this, and take a step towards working with us. That's the best way I would encourage people to go.
That's great. Obviously, it's always good for people to have open minds and see what's out there. And you would think that lowering, deferring taxes is something that people should be interested in, especially as people are starting to get older. They're going to be selling assets that they've held on for a long period of time with huge appreciation. So certainly something to think about. I wish you good luck with the DSTs, with your podcast, and finding people that like to defer capital gains. Thank you very much. Thank you for coming on, Brett, and I appreciate it. So if you want, you can do a shout out for your website
Oh, yeah. People want to get in touch
that.
with me. Yeah, you go to capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. You can also check out the book with Kevin Harrington from Shark Tank, Building a Capital Gains Tax Exit Plan. You can get it on Amazon, but capitalgainstaxsolutions.com to get started on building a plan with our team.
Excellent. Thank you very much. So everyone, thanks again for listening in for the Adventures of a Real Estate Broker. Until next week, thanks for tuning in. If today's stories opened your eyes, wait till you see what's next. Hit the video on screen to join the next adventure with Daniel Berger.